This is the DoughRoller Money Podcast, episode number 188. My name is Rob Berger, the founder of DoughRoller.net and the host of this podcast. And today we're going to talk about the perfect asset allocation. Yes, it does exist, and I'm going to tell you what it is in today's episode.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, hope you're having a great day. And I've been looking forward to this podcast. And it sort of the idea behind today's show came from, frankly, from you, from a ton of email that I get from folks, certainly every week, sometimes daily, regarding asset allocation. And the emails will often ask me things like, how important is it to have small cap value fund in my investments? How important is it to have a REIT fund? How important is it to have emerging markets? How important is it to have even just small cap versus mid cap versus large cap? And the questions come in different forms. Sometimes you guys will, and I love getting these emails, you'll actually lay out your investments and the fund, the ticker symbol, what percentage you have, whether it's in a 401k or a taxable. I mean, some of the emails that I get are incredibly detailed. And a lot of times folks will want to know, so what do you think of this asset allocation plan? And it's not that I don't have an opinion, but I'm not really in a position to give folks specific investing advice. If I were going to help someone, there's a ton of questions I'd have about their approach to risk and their goals. And, I'd want to know, and this may sound odd to some, I'd want to know about your debt because the fact is our investments are part of a bigger picture and we need to take a holistic approach to our investments. And someone with no debt is going to be able to handle, in my opinion, a downturn in the stock market, all other things being equal, better than someone who's got school loans and car loans and mortgages and just really kind of feeling the pressure of a lot of debt. So I would need to get a total picture of someone's finances. So I tend not to give specific advice. My approach is different. It's really hopefully to arm you with the tools and information you need so you can make a reasonable, intelligent decision on your own. But all these emails got me to thinking, well, why not just give you the perfect asset allocation? I'll just tell you what it is. And so in the future, when folks email me, I'll just say, hey, no worries. I got your email. Appreciate it. Go listen to podcast number 188. And you'll get all the answers you need. Now, for those that have listened to a lot of shows, you're probably thinking, yeah, I'm not so sure Rob's going to give us a perfect asset allocation. Well, you're kind of right. But I hope this episode will be helpful to you, particularly for those that are trying to figure out exactly how you should invest your money, what funds you should pick, what asset classes should you have. I hope this will help you. And again, I hope I can forward this to folks that email me about this topic in the future. So before we get into the details, a couple of things. You can find the show notes to this podcast at DoughRoller.net/podcast 188. I'm going to cover sort of a lot of stuff, a lot of resources, and they'll all be in the show notes. So if you're driving, whatever, don't worry about, writing anything down. Just go to DoughRoller.net/podcast 188. It'll direct you to the show notes for this episode. You'll be able to see all of the links. That's the first thing. The second thing is if you want to email me, you know this, but dr@DoughRoller.net. So if you have questions about this show, about this episode, topics you want me to cover, and I've gotten a lot. Like just today, I got a question that I'm going to absolutely do a show on because I have a lot of thoughts and feelings about this question, and that was Visa and MasterCard. Are they good investments? Are they good investments or not? And it's something that I have actually, believe it or not, I don't own either stock, but I've spent a lot of time thinking about Visa and MasterCard and their future and how they compare to, say, an investment in, ExxonMobil, for example. How would you even think about the differences between the two? Anyway, I get a lot of great email, and I've got a lot of backlog, and I'm doing the best I can to get to them, but would love to hear from you. So shoot me an email, dr@DoughRoller.net. And then lastly, before we get into today's show, if you want to support the podcast, you can do that, DoughRoller.net/support. Now, by the way, on the support, I don't talk a whole lot about it. But I will say this: when you go to that page, DoughRoller.net/support, you can sign up to support the show on a monthly basis through PayPal for as little as a few bucks a month. And I'm grateful for those that are already supporting the show, and grateful for those that will support it in the future. However, I do recognize that, for any variety of reasons, not everyone's going to want to support the show financially. There are other ways you can support the show. You can tell your friends about the podcast. You can leave a review in iTunes. You can email me your questions or things you'd like to hear about in future episodes. I find that very helpful. Helps me kind of know where everyone is and what's important to folks and what they want to know and what they'd like to, what they'd like the show to cover. So that's another great way to support the show. So a lot of different ways that don't involve money. Okay, now on to the perfect asset allocation. So a little story. When I started investing, which was 1993, I think, and I started reading more and more about mutual funds. They didn't have ETFs back then, I don't think, but mutual funds and stocks and bonds and trying to understand all of this. I would read books. Of course, this was really before there was, much of an internet, right? 1993. So it's not as if I could just hop on the internet and do some searches. So it was a lot of books. And then, of course, the internet, as it got into full swing, helped a lot. And I was very focused on the historical performances of different asset classes and slicing and dicing my portfolio, small cap value. I had micro cap funds, and dimensional fund advisors was one that people talked a lot about. And I've had questions about DFA, and I like their mutual funds. It's just that you can't buy them directly. You've got to go through an advisor. And as a result, I've never owned shares of a DFA fund. I would, frankly, if it were open to retail investors and I could buy directly, I'd probably invest in some of them. But they slice and dice indexes in a way that's a little different than, say, a Vanguard or Fidelity. And so I studied all these different asset allocation plans in search of the Holy Grail of investing. How do I get that, that perfect, whatever that might be, that perfect investment plan? And then, of course, I lamented the choices I had in my 401k because I came up with this, what I thought was the perfect investment plan. And then I looked at my options in my 401k and it was like, yuck, I can't implement this. I can't implement this because I don't have access to DFA funds. I can't implement this because the funds I do have aren't perfect or right. Yeah, I spent a lot of time thinking about all that. I know it sounds kind of pathetic in hindsight. In any event, as I invested more and had more experience, I slowly began to learn what really matters and what doesn't matter as much. And I started distinguishing between the really important decisions, such as your stock versus bond allocation, to me, a critical decision, and probably less important decisions, like whether you own a micro cap fund or not. Perfectly fine if you do, but probably not the most important asset allocation decision that an investor will make. And so as I thought about these issues and all the email I was receiving from you, a couple of questions came to mind. I thought I'd share them in this podcast about the perfect asset allocation. And the starting point was, all right, well, where might we go to find examples of investment plans put together by really smart, informed people? Where would we find those? And the reality is there are all kinds of investment plans that are available, examples of asset allocation models that are readily available on the internet. And I want to cover in today's podcast 4 sources, 4 places you can go, and I'll give you examples of each of them, where you can go to see how the professionals would slice and dice an investment portfolio. These are all kind of with retirement in mind. So in other words, long-term investing. 4 of them. All right, let's go right through them. The first one, target date retirement funds. Fidelity has them, Schwab has them, Vanguard has them, and these are funds where you put all your money in a single fund, and based on how many years you have left until retirement, the mutual fund company, we'll use Vanguard as an example, will take your money and put it in a couple of mutual funds. And we can look and see how they would invest your money. A great source. I mean, folks at Vanguard are really smart, and they spend a lot of time thinking about this. And I use Vanguard as my example, but the same is true with Fidelity and all the others. These are, really smart people, given this a lot of thought, have a lot of resources at hand. And even if you don't invest in a target date retirement fund, you can use the information to see how they would invest your money. Now, that doesn't necessarily mean you'll mimic what they do. Again, right now we're just kind of looking at examples. And so if you were to Google, and I'll have links to this in the show notes, but if you were to simply Google Vanguard Target Retirement Funds, you would see their examples. And they have, it's based on your age. So, if your current age is 18 to 22, Vanguard would recommend the Target Retirement 2060 fund. Kind of hard to imagine 2060. That seems like, it's part of some futuristic movie. Anyway, if you're 18 to 22, if you're old like I am, you'd be in the 48 to 52 bucket. And that would be Target Retirement 2030. And you can click on any of these once you're at Vanguard, and it will show you exactly what percentage they would put in bonds versus stocks, and then how they would break that out. So in my case, for the 2030 fund, they would have 75% in stocks, roughly, 25% in bonds, and you can look at the specific holdings. They're I think all of their target date funds are 4-fund solutions. So they put roughly half of it in a total stock market index fund, which is a U.S. Stock fund, about 28% in an international stock fund. They put 17% in a total bond market fund, and then about 7.5% in a international bond fund. Right there you go. That's how Vanguard would do it if you were roughly my age, retiring in 2030. Obviously, if you're younger or older, you can pick the different target date retirement funds. And it's interesting, by the way, and this may be even for another show, but to compare, say, how Vanguard does it versus Fidelity. If you were to go and look at Fidelity's target date retirement funds, you would find they don't use 4 funds. I think they'll use as many as 8, 10, 12 funds. They really slice and dice it a lot more than Vanguard. It's not to say that one approach is better or worse, but you can see the difference. And it's definitely a very different approach to retirement investing between even just Fidelity and Vanguard. But that's one place that you can go to see examples of an asset allocation plan, and to learn from them and to assess, what you think of their approach. That's the first one I want to share. First of 4. The second one is Robo advisors. We've talked about them: Wise Banyan, Betterment, Future Advisors, Wealthfront, and there are others. They all have their own asset allocation plan, and the one I'm looking at now is Wealthfront. They actually have a white paper. Again, I'll have the links to this in the show notes. Very detailed. Actually, it's a great read. It's pretty in depth. You're going to want at least a half hour to get through this and understand it. But at the end, they have their sort of recommended asset allocation plan for a taxable account, and then for a retirement account. And they are different. They'll have, for their bond funds in a taxable account, they'll use a municipal bond fund because there's some tax advantages to it. There'd be no reason to have a municipal bond. In fact, you would not want a municipal bond fund in a retirement account. So for retirement accounts, they have a corporate bond fund, an emerging market bond fund. But you can see their asset allocation. They have U.S. stocks, foreign stocks, emerging markets. They also allocate a separate portion to dividend stocks, U.S. dividend-paying stocks, natural resources, commodities, and then municipal bond funds. That's the taxable account. But that's another example of an asset allocation plan that's been built by some really smart people at Wealthfront. And again, that's just one example. You can look at Betterments. Theirs is different. And you can look at Wise Banyan. You can look at Future Advisors and others. But there is a second example of a investment plan that's built by folks that really know what they're doing. Our third source is, of course, from books, and 2 of my favorites. I've mentioned these in the past: Rick Ferri's All About Asset Allocation and Swenson's Unconventional Success. Now, I had an opportunity. I've known Rick for many years and interviewed him. Actually, my third podcast. I think it was my third. Let's see. Yes. I interviewed Rick in DoughRoller.net/podcast 3. He's written a number of books. One is all about asset allocation. And he walks through his views of what a good, solid asset allocation would be. Again, if you want to know more about that, you can check out podcast 3 and or his book, All About Asset Allocation. And then in podcast 163, so DoughRoller.net/podcast 163, I talked about David Swenson's book, unconventional success. Swenson runs the Yale Endowment, which has, I don't know, I think it's over $20 billion, ridiculous amount of money that he manages. And he has his what he views as sort of a rock solid asset allocation plan for regular retail retirement investors. We've talked about it. You can get more details in podcast 163. But his starting point is a 70-30 split between equities and bonds. He puts 30% in U.S. equities, 15% in foreign developed markets, 5% in emerging markets, 20% in REITs. And then his bonds are split evenly, 15% in U.S. Treasuries, 15% in TIPS. By the way, just as a side note, the reason why 15% in TIPS, which are Treasury and inflation-protected securities, they protect you against inflation. If inflation goes up, then there's a piece of the TIPS that increases the interest rate that you would receive to sort of match that inflation. And then 15% in just good old regular traditional U.S. Treasuries, regular bonds. Without diving deep into the weeds on why, basically TIPS will do better than your sort of traditional bonds if inflation turns out to be higher than folks expected it to be. Why? Because it can adjust upwards for the inflation. Treasuries, or sort of traditional bonds, tend to do better when inflation turns out to be lower than people expected. And there's a whole bunch of reasons why that I won't go into, but his idea is you have 15% in U.S. Treasuries, 15% in TIPS. You're sort of protected either way. If down the road inflation turns out to be higher, you're covered with the TIPS. If it turns out to be lower than what people expected, you're covered with U.S. Treasuries. Anyway, that's David Swenson's view of sort of a solid asset allocation plan. Obviously, there are a lot of other writers. Bogle has written great books. William Bernstein has written great books. I just mentioned two, all about asset allocation and unconventional success by David Swenson. But those are two books that lay out some asset allocation plans that are, in my view, rock solid. That's the third example of where to go to find good, solid investment plans. The fourth and final one that we're going to talk about today is the Bogleheads Forum. And, of course, that's named after Jack Bogle, John Bogle, founder of Vanguard. And I'm going to leave, again, in the show notes, a link to one of the pages on the Bogleheads Forum called Lazy Portfolios. It's a great page that lists a whole bunch of different asset allocation plans from different folks. I mentioned Rick Ferry. He has what he calls a two-fund portfolio. It's not his only asset allocation plan. That's listed here. There's a three-fund portfolio, and actually a couple different versions of the three-fund portfolio. All that is an asset allocation plan that focuses on U.S. stocks, international stocks, and bonds. And a three-fund portfolio can, as the name suggests, be implemented with just three mutual funds. And that's true whether you use Vanguard funds or someone else, Fidelity, Schwab, T. Rowe Price, whatever. But there are a couple of different variations of the three-fund portfolio. One of the nice things about the page on the Bogleheads Forum, again, I'll leave a link in the show notes, is they give you examples of specific mutual funds that you can use to implement each of these asset allocation plans. So there's the two-fund portfolio, the three-fund portfolio. There's a core four portfolio that adds, in addition to U.S. stocks and international stocks and bonds, also adds REITs in a REIT fund. And there are several others that you'll see on this page, some involving 10 different asset classes that include large value, small blend, small value, Pacific, Europe, short-term bonds, and on and on and on. Another great resource with a lot of solid asset allocation plans. Now, I've kind of gone through all of these for two reasons. One is just to give you a source of asset allocation plans so that you can check them out. And it's a great starting point to building a portfolio. Of course, you may be saying, well, that's fine, Rob, but which one? Do I follow Vanguard's target date retirement fund? Do I go to a Robo advisor and follow what Wealthfront did? Even the books, Unconventional Success, All About Asset Allocation, or some other? Do I follow, even the Boglehead form? You go to the page, it's great, but there's not just one asset allocation plan. There's several. Here's the thing. All of these different investment plans have three important things in common. Maybe they have more than just three, but three important things. Actually, the third thing I think is the most important for our purposes, but I'm going to cover three. The first one, they're all very diversified. Even a two-fund portfolio, Rick Ferry's two-fund portfolio that you will see if you go to the Bogleheads forum. Again, the link will be in the show notes. A total bond market fund and a total world stock index fund. You're talking about thousands of companies in the stock fund and thousands of different bonds in the bond fund. Incredibly diversified geographically, incredibly diversified by industry, incredibly diversified by size of the company. There's value. There's growth companies with bonds, all different types of bonds, whether it be government, corporate. It's just an incredibly diversified portfolio in just two funds with just two asset classes. It really, when you break it down, you can see a lot of different sub-asset classes in these bond and stock funds because they're so diversified. But the first thing that all of these asset allocation plans have in common is extremely diversified. The second thing they have in common, by and large, is that they have a pretty significant tilt towards equities, particularly for long-term investors. Again, they're not all going to be the same, but they're going to be 70% equities, 30% bonds, or perhaps maybe 2/3 equities, maybe 80% equities. They're going to have a heavy tilt towards equities, which is really critical for long-term investors. That's the second thing they're going to have in common. The third thing they're going to have in common, though, I think is the most important for our purposes today, and it is no two are alike. You say, that's really what they don't have in common. Maybe. Every single one of these asset allocation plans are different. Again, whether you're dealing with target date retirement funds from big mutual fund companies, the Robo advisors, they're all different. The various books, Rick Ferry's model asset allocation plan is a little different than David Swenson's, and his is going to be a little different than William Bernstein's. And all of those, are going to be different than a lot of the asset allocation plans that you'll see in the Bogleheads forum. They're all different. And that's really the key, I think, to today's podcast, today's show. That is, you're going to drive yourself crazy trying to find that perfect asset allocation plan. It doesn't exist. There is no one single right way to do this. And that's, if you take anything away from today's show, that's the key. If you're driving yourself crazy trying to get the perfect asset allocation plan, or if you think you have it, but you're going crazy because you can't implement it, given the investment options, say, in a 401k or a 403b, or if you're looking at a Robo advisor and you kind of like their asset allocation plans, but you can't find one that's absolutely just the perfect plan that you had envisioned, take a step back, take a deep breath, and recognize there is no perfect asset allocation plan. We can certainly look at history and see how different asset classes have performed. It's useful information. It's what drives a lot of folks to focus on things like small cap value, because small cap value over a long period of time is generally outperformed by a little bit. Say larger company, S&P 500 stock, although for that matter, so is emerging markets, right? You could take that view to the extreme and say, well, heck, let's just throw everything out and just put all our money in emerging markets. Of course, that gets people a little nervous, and rightly so. So, you can look at this history, and it's important to look at the history of the different asset classes. But even when you do that and you try to put together a good mix of asset classes for an investment plan, you're going to have really smart, educated, informed folks who've put a lot of thought into this disagree, right? And they're going to have different asset allocation plans. That's okay. I still think for individuals, we can come up with asset allocation plans that are perfect for us. And that gets me to sort of the third and final part of this show. How do we do that? We've got all these experts telling us really good things, but none of them are exactly the same. They're going to be different, and we're going to have different options in our 401k or 403b. How do we get to an asset allocation plan that's perfect for us? And here's my take on that. 4 things. Ready? Number 1, just like all of the asset allocation plans we've looked at, they must be diversified. For me, that includes having investments in 4 categories: U.S. stocks, international stocks, bonds, and REITs. I throw in REITs. I think REITs are important. I think their returns are very good long-term, and I think they give us diversification. For me, I like those 4 asset classes. Now, by the way, when you look at someone like Betterment, you'll see that they do not have a separate REIT fund in their asset allocation plan. And you might say, well, wait a minute, do they not believe in real estate? No, they do. They just believe you get exposure to real estate through the other ETFs that they own. Because even if you invest in an S&P 500 fund, that's going to include significant exposure to real estate in a whole host of different ways. Companies that own real estate, even if they're not in the real estate business, for example. So you're going to get that kind of exposure. In my view, I prefer to have 10% specifically in REIT funds. That's my personality. I think that gives me diversification. An asset allocation plan that doesn't do that doesn't make it wrong. But for me, diversification, U.S. stocks, international stocks, bonds, and REITs. Number 2, we've talked about it, but I think it's important to have a tilt towards equities. I think the starting point for long-term investing is 70% stocks and 30% bonds. That's the starting point. That doesn't mean you can't become more aggressive than that. It doesn't mean that something a little less aggressive is necessarily bad. But when I talk to folks and they've gotten scared and they've gone all to cash, and I talk to folks that do that, I cringe. To me, that is not a good place to be if you're a long-term investor. I understand the desire to maybe time the market. I'm just not very good at it. And by the way, I don't think anyone is. That's my view. So the perfect asset allocation plan is going to be diversified. It's going to have a tilt towards equities. But here's and of course, all of the plans we've talked about satisfy those 2 criteria. So you're saying, well, Rob, that's great, but you haven't told me anything, you hadn't said earlier in the show. Okay, well, number 3, it has to fit your personality. This is where I think people get lost. They think that asset allocation and investment plans are just a scientific issue. Let's just look at the history and we can sort of run some numbers and out comes this perfect asset allocation plan. The problem with that is we've got to have one that fits our personality. And what do I mean by that? Well, I mean a couple of things. First of all, certainly our ability to withstand a down market. From 2007 to what it was, I think March of 2009, I think is when it hit the bottom. Stocks lost 57%. And a lot of people could not handle that, and they got out at the worst time. Some, and I talked to them, some of them haven't even gotten back in yet, and they've missed the incredible stock market run that we've had over the last number of years. So, your asset allocation plan has to fit your tolerance, your risk tolerance, and by risk I mean volatility, your ability to withstand a falling market. And, if you've not experienced a really bad market, maybe you started investing after 2009, you're not going to really know how you do in a bad market until you experience it. And you could go through a bad market and do just great, maybe because you didn't have a lot of money invested. But then as you get older and you invest more and you invest more and you get closer to retirement, your ability to withstand a down market actually weakens, becomes harder for you because you can kind of see the light at the end of the tunnel as you may be near retirement, even if you're still 10 or 15 years away. But you've got more money now. It's one thing to lose 57% when you've got $10,000 invested. It's a whole other thing to lose 57% when you've got $100,000 invested, or $1 million invested, or $5 million invested. So your tolerance for risk can change over time. But that's the first thing. You've got to make sure that your asset allocation plan fits your personality in terms of your tolerance for volatility. And, you can take all the online quizzes you want, and you can talk to all the smart people in the world that you want. But at the end of the day, only you are going to know through your own experience, your own assessment of your finances, what kind of volatility you can handle. That's the first thing. The second thing is complexity. Every time you add a new asset class to an investment plan and a new mutual fund or a new ETF, it increases the complexity. It increases the number of funds that you have to evaluate and choose. It increases the complexity when it comes time to rebalance. And there's no right or wrong here. It comes down to your personality. I know folks that have 20 different ETFs in their very complicated portfolio. They share their spreadsheets with me. I look at it and kind of smile. I'm like, wow, this is some serious stuff here. I'm not sure how you keep all this together, but if it works for you, that's great. They love the complexity. They have funds that, they have specific funds just for China. Forget the total stock market, a total international fund at Vanguard. No, they've got an ETF just on China. It's a very complicated portfolio, and they kind of like that. They like the complexity. Others are like, that's the absolute last thing I want. I want to keep this simple. The 3-fund portfolio is for me. Don't underestimate the importance of the complexity versus the simplicity of your investment portfolio. As I've gotten older and invested more, I've moved away from the complexity and moved towards simplicity. And by the way, that's true even with my individual stock investments. Of course, that to some, that's a complexity totally separate from asset allocation plan, and I understand that. But even in my individual stocks, I have a pretty significant amount of money invested in just 6 stocks. Six companies. My individual stocks, I don't ever see owning more than 10 tops. I'm not going to, own 20 or 30 individual companies. I keep it very, very simple. And in terms of diversity, my asset allocation or my investment plan as a whole is incredibly diverse, even with, I've probably got 20 to 25% of my portfolio in 6 stocks. Even with that, incredible diversity when you look at it in its totality. But still, I'm moving towards the more simple approach in my investments. And I've continued to move towards simplicity and get rid of some of the fringe, I'll call them fringe asset allocation or asset classes, like, for example, micro cap fund, which I've moved away from. Not that there's anything per se wrong with that approach. I just felt that I wanted to move towards a simpler asset allocation plan. So that's the second thing. You really want to make sure as you get more and more complex that you're comfortable with that complexity. You're comfortable with rebalancing a complex portfolio. That's the second thing. You want to make sure that fits your personality. The third thing, and it's similar to number 2, but it's a little different, and that is the desire to slice and dice your portfolio. Some people just, they say, look, small cap value has outperformed the S&P 500, and I want exposure to that. It's not that I'm looking to make my portfolio more complex or less complex. It's just that I look at the history, and I feel that I'm just going to go crazy if I see the small cap value over the next 10, 20, 30 years outperforming the S&P 500, and I don't have some additional exposure to that. And that's fine. If that's what you want, that's where you have to assess the asset allocation plan to make sure it meets your personality. I have some of that in my plan, particularly as it relates to emerging markets. I want an addition. I could just go with one total international fund that would have some exposure to emerging markets, but I want some additional exposure to emerging markets. And so I get that through the Vanguard Emerging Market Index Fund, and I'm comfortable with that. I do have a small cap value fund, but it's one that I've had for a while, and it happens to be in a taxable account. Frankly, I keep it because to sell it would generate a ton of taxes. And it's not that I'm unhappy with the fund or that I regret being in it, but if I were to start today, I probably wouldn't go to that level. Again, some are perfectly fine with the 3-fund solution or a 4-fund solution, adding REITs, and that's all they need. Others, it's their personality. They're just going to be restless if they just have those 4 funds and they want a small cap value. Or in my case, they want an emerging market. That's fine. You just need to know your personality and to come to an asset allocation plan that matches with your personality. Why is that important? Because if you don't have an investment plan that matches your personality, you're not going to stick with it. You're eventually going to abandon it, and you're typically going to abandon it at the absolute worst time. So it's very important to make sure that your investment plan is suitable to your personality, whether it's to risk and volatility, complexity versus simplicity, or simply wanting some exposure to some additional asset classes like small cap value or emerging markets or whatever. The fourth and final thing for the perfect asset allocation plan for you is it's got to fit in with the investment options that you have available to you. This usually comes up with 401ks. We've talked about this many, many times. You're going to have, in most cases, some limited choices. Hopefully, you have some good options in your 401k or 403b, but you won't always. And we've talked about that in the past and what you can do if that's the case. But as you map out the asset allocation plan that works for you, we got to deal with reality, and that means coming up with a plan that you can implement with the investing options that you have with your employer. Now, you may have a complicated, more complex situation where you have a 401k with your employer. You may have IRAs, you may have taxable accounts, you may have some traditional versus Roth, and it gets a little more complicated. And that's fine. That's just the way it is. But as it relates to your 401k or your 403b, you're going to have to make sure you can implement the plan that works for you with the investment options that you have. What I do is I find the one or two or three investing options at my 401k that I think are good, and there are a couple. I have Dodge & Cox International Fund. It's a actively managed fund, but relatively inexpensive as active managed funds go. I have a Vanguard index bond fund at my through my 401k, and I have a good low cost, I think it's Fidelity, S&P 500 index fund. So I've got a couple of really good options with my 401k. And so as I map out my investment plan, as it relates to the 401k, I allocate all that I need to those available funds for my plan. And then in my taxable accounts and my IRAs, where I have far more flexibility, mine happen to be at Vanguard, but that's totally up to me, right? I can make a choice as to where I want to invest my money in my IRAs and my taxable accounts. Then I have a lot more flexibility to implement the remainder of my plan. So the real key takeaway here is there is no perfect asset allocation plan. We can look at all of the experts, and they are great plans to consider. Find one that you think is best suited to your personality and to your investing needs, bearing in mind that smart people are going to disagree on the perfect asset allocation plan, but you got plenty of really good plans to consider. Again, whether it's a target date retirement fund, Robo advisors, books, Bogleheads form. You may have other sources as well, but they're all different. None of them are the same. And then make sure you start there, but then modify as necessary to fit your investing personality and to fit your investing options at your 401k or 403b. So if you want to email me and say, Rob, you're crazy, you've absolutely got to have the microcap value fund, that's fine. Go ahead and email me, dr@DoughRoller.net. Again, I've kind of moved away from that. I think there are a lot of different asset allocation plans that are reasonable. The reality is we do not know how these various asset classes will perform over the next 20, 30, or 40 years. Small cap value might outperform the S&P 500. It might not. Same is true with emerging markets. More importantly, these asset classes may or may not outperform, say, the S&P 500 over your specific investing timeline, which is going to, of course, be different than mine, most likely. And, the fact is you can pick certain time periods, even lengthy time periods, over the past 10, 20, 30, 40, 50 years in which some of these asset classes didn't outperform the S&P 500. So I've gotten to a point now where while I look at this history and I use it to think about investing and think about asset allocation plans, I have convinced myself that there's simply no guarantee that one, they're going to repeat themselves over the next 10, 20, 30, 40 years, or more importantly, that they're going to repeat themselves over my investing horizon. So start with a lot of these good resources. Again, they'll be in the show notes, DoughRoller.net/podcast188. A lot of very solid asset allocation plans. Look at them, compare them, find one that you're comfortable with, that fits your personality for complexity, for simplicity, for risk tolerance, your desire to maybe slice and dice your portfolio perhaps a little more than others or a little less than others, and finally that fits your investment options in your 401k, 403b. And I think you will arrive at an asset allocation plan that's perfect for you. Hey, hope this helps. Shoot me an email with your comments, your questions, future topics, whatever, dr@DoughRoller.net. And until next time, remember, the best thing money can buy is financial freedom.